Hi friends, welcome to eNotes MBA. Today we are going to study basic terminologies of accounting. Topic of Chapter 1, Introduction to Accounting, of subject Accounting for Managers. In the previous video, we let you know what the term accounting means. You got to know the meaning, definition, evolution, characteristics, scope, and system of accounting. Before studying the next topic of accounting, we need to first understand the basic terminologies of accounting. So, the objective of this video is to make you familiarize yourself with some of the common terms of accounting. So, let's begin with the first term, capital. Capital is the amount initially invested while commencing a business. It can be in the form of cash, goods, or any type of asset. Even after commencement, additional capital can be introduced. The additional introduction of capital can be done in case of expansion of business. Profit earned in the business is added to the capital, and the loss made in the business is reduced from the capital. So, if the business is profitable, capital would be on increase year after year. In case of continuous losses, capital would be on a decrease year after year. The term capital is defined as the excess of assets over liabilities. That is, capital is equals to assets minus liabilities. For example, if a firm has assets of rupees say 1 lakh and liabilities of say 20,000, then the capital will be equals to 1 lakh minus 20,000, that will be equals to 80,000. Now suppose the firm has made a profit of rupees 40,000. Now how much is the capital of the firm? 1 lakh assets minus 20,000 liabilities plus 40,000 profit, that will be 1,20,000. So now the capital of the firm is 1,20,000. Next term is drawings. Drawings are the amount withdrawn from the business by the proprietor in a proprietorship firm or by the partners in a partnership firm. It can be in form of cash or goods. Drawings are reduced from the capital amount. For example, the proprietor has withdrawn cash, say 5,000 rupees, and goods, say of rupees 5,000, that will be equals to 10,000. So the drawings is equals to 5,000 plus 5,000, 10,000. Now, how much is the amount in the capital account? Assets were of rupees 1 lakh, liabilities 20,000, profit 40,000, and now drawings will be reduced by 10,000. So the capital is equals to 1,10,000. Next term is turnover. The total amount of sales during a particular period is called turnover. It can be in form of cash, credit, or both. Next term is discount. The allowance or concession granted to a retailer by the dealer or wholesaler is called discount. It can be of two types: trade discount and cash discount. Trade discount. Trade discount is allowed by a dealer to the retailer or buyer to induce him to buy more from him. It can be offered on both cash sales and credit sales. The invoice shows the list price or retail price. Where trade discount is allowed, the same is also shown in the invoice. Trade discount is allowed as a fixed percent on the list price. Net price is equals to list price minus trade discount. For example, list price of a product is say rupees 500 and trade discount allowed is 10%. So the net price will be equals to 500 minus 10% of 500. That will be equals to 500 minus 50 equals to 450. So the net price is rupees 450. It is important to note that the net price is entered as sale value by the seller in the accounts. Equally, the net price is entered as the purchase amount by the buyer in the accounts. Or we can say, no entry is made for the trade discount separately in the books of accounts of the seller or buyer. But it has to be mentioned in the narration about the trade discount given on the list price. Cash discount. Cash discount is allowed by the seller to encourage the customer to make early payments before the credit period expires. Cash discount comes into picture as and when credit sales are made. Cash discount is given in case of credit sales. There is no cash discount given on cash sales. In case of cash sales, no credit discount is given. It is given only in case of credit sales. For the seller, it is recorded as discount allowed. And for the buyer, it is recorded as discount received. Next term is debtor. The person to whom goods or services are sold on credit is called debtor. The amount due from the debtor is called book debt. Next term is creditor. The person from whom goods or services are purchased on credit is called creditor till the payment due to him is made. Next term is bad debt. Amount that cannot be recovered from a debtor is called bad debt. Bad debts result in reduction of profits of the firm. Bad debts are charged to the profit and loss account, or we can say bad debts are treated as an expenditure as the amount due to be received would no longer be received. Next term is transaction. Transaction refers to an exchange of goods and services. The exchange of the dealings has to be expressed in terms of money. In terms of money, the transaction can be either for cash or on credit. For cash or on credit. If the payment is made immediately to the transaction, it is called a cash transaction. If the payment is postponed or deferred for the future date, then it is called a credit transaction. Next term is voucher. Voucher is a written document or paper containing the details of the transaction. The person who prepares the voucher, normally an accountant, signs it. A person who verifies or checks the transaction also signs it in token of his verification. Vouchers are important instrument for future reference. Voucher can be a debit voucher or a credit voucher. Debit voucher or credit voucher. Voucher is normally accompanied by the supporting document as proof. For example, a voucher may be supported by the bill. Here, bill is the evidence of payment. Next is asset. Assets are the properties, tangible or intangible, owned by an entity or enterprise. They are the economic resources of the business. Anything which will enable the firm to get economic benefit in the future is an asset. For example, land, building, machinery, furniture, or stock are tangible assets. And trademark, copyright, or goodwill are intangible assets. According to Finney and Miller, assets are future economic benefits, the rights which are owned or controlled by an organization or individual. According to R. Brockington, assets are property or legal rights owned by an individual or a company to which money value can be attached. According to Professor R. N. Anthony, assets are valuable resources owned by a business which are acquired at a measurable money cost. On the basis of these definitions, we can say assets should be owned by the business, assets may be in tangible form or intangible form. Assets should have some value attached to it. Fourth, assets should be capable of being measured in terms of money. Assets can be divided into two categories: fixed assets and current assets. Fixed assets are the assets owned by the organization for the purpose of conducting business using them, like land, building, machinery, etc. Current assets are those assets which are held by the organization for the purpose of carrying on business. Current assets normally change their form, like cash, bank, finished goods, or debtors, etc. Next is liabilities. Liabilities are legally binding obligations that are payable to another person or entity. Settlement of a liability can be accomplished through the transfer of money, goods, or services. Advances or loans received have to be repaid. Till date of repayment, they are liabilities. Goods or services when bought on credit are shown as creditors, which are also liabilities. Capital invested by proprietor or partner is also a liability, as the business firm is independent from them, so far as accounting is concerned. This is the reason why capital is shown on the liability side in the balance sheet. Outstanding expenses and bills payables, outstanding expenses and bills payable are also the example of liabilities. Next term is debit. The entry made on the debit side of the account is called debit. The abridged form of debit is Dr. Next term is credit. The entry made on the credit side of the account is called credit. The abridged form is Cr. Next is entry. The record made in the books of account in respect of a transaction or an event is called an entry. Next is books of account. The registers or books maintained by any business firm or institution for recording the business transactions are called books of account. Okay friends, that's all in this video. I hope you understood these terms very well. If you want to read this chapter or these terms in detail, you can refer our blog enotsmba.com. Thanks for watching. If you like this video, please hit the like button. If you want to see more videos, please do subscribe our channel enotsmba. If you have something to say, please leave a comment. And if you want to read this chapter, please log on to www.enotsmba.com. Thank you.